Okay. Good morning, ladies and gentlemen. In our previous lecture, we had discussed where we had an impairment in the past. We had an impairment in the past, and the circumstance the next year had led us to understand that the impairment didn't exist anymore. And when the that circumstance didn't exist anymore, and our recoverable amount was now higher than our carrying amount, we processed a reversal of impairment. Right? So our recoverable amount in this example went to 950, and our value was at 7466. Right? So we reversed our impairment, but we didn't reverse it up until the recoverable amount of 950. We were limited to the historical carrying amount. The historical carrying amount is what the carrying value would have been if there was no impairment, but just depreciation. So that's why to keep a record of your historical carrying amount, which is your asset at the beginning, and only accounting for depreciation as if nothing happened, is important. Right. So we could reverse the impairment, but only up until 800,000. We couldn't go all the way up to 950 because so we went from 740,000 to 800,000, and that was the reversal of 53,000. So far we have just looked at depreciation and impairments. So where we didn't go above the historical carrying amount, that's what we were discussing so far. And then we went on and we said that when you are doing IAS 16 or you're recording your property, plant, and equipment, there is another choice that you can make. The accountant can make the choice to record the property, plant, and equipment using the revaluation model. Now, in the revaluation model, it differs because an increase in fair value or above the historical carrying amount, we can account for that under this model. It's only under the revaluation model we can account for increases to fair value. Right. So we looked at an example. We said the value increased from 2 to 3. How did we account for them? We recorded a revaluation surplus. So from 2 to 3, there was a 1 million revaluation surplus. How are we going to disclose that? Right. So 1 million goes to revaluation gain. We see the revaluation gain on the statement of comprehensive income for the year. So if it happens during the year where there's a gain, you will see it, but you won't see it under your normal profit and loss section. This is where you see your normal, like your sales, your cost of sales, your uh, admin expenses, all those kind of things are normal profit and loss. Revaluation goes under another section known as other comprehensive income. Right, so you'll see the revaluation. So for our example, in the statement of comprehensive income, statement of profit and loss and other that's what this stands for. Under other comprehensive income, you'll see the revaluation gain 1 million. That revaluation gain goes to your revaluation surplus account. Right? You credit revaluation surplus, just like how all profits and losses go to your retained earnings. Right? All revaluation gains or losses go to revaluation surplus. Revaluation surplus is an equity account, just like retained earnings, that you'll see in your statement of changes in equity. So here's an example of a statement of changes in equity. Now you get your share capital, you also get your retained earnings, also known as retained profit. You'll have a new column known as revaluation surplus. You'll have an opening balance, you'll have the movement for the year, and you'll have the closing balance. So if we were using our information from our example, we would have a zero opening balance, then we'd have a revaluation gain of 1 million and a closing balance of 1 million for 2003, the end of 2003. We also looked at a case where now the fair value goes down. It is reduced, but not below the original 2 million. It's just reduced by 500,000. So there was an increase of 1 million, and next year there's a decrease of only 500,000. In that case, we would be able to reverse the revaluation surplus to account for that decrease. We wouldn't have to process any impairment because we're not going below the historical cost amount. So the total decrease of the 500,000, which is to get to the 2.5, will be called revaluation loss, which goes to your revaluation surplus account. It will decrease your revaluation surplus. Right. And that under your statement of changes in equity, you will see here for the year under revaluation surplus, you'll see a decrease in amount in brackets, revaluation loss, and it will go down by 500,000. Then the last event that happened was the fair value had a further decline, and that decline was below the 2 million. So from 2.5, we are going not only down to 2 million, but we're going even below that. So the amount down to the original cost, the 2 million, that will be the reversal of whatever's remaining from the previous revaluation, which is 500,000. Right, we'll reverse the revaluation, the equity account. So to debit, it will decrease revaluation. And then to go below the 2 million, that will be an impairment. So you will debit impairment expense. Your impairment expense is a normal expense. It will go under your profit and loss section in your statement of comprehensive income. So it will be here under net operating costs, right? Profit and loss section. The revaluation surplus, the decrease, the 500,000, the revaluation loss will go here under other comprehensive income. Obviously, it won't be a revaluation gain, it will be a revaluation loss of 500,000 in brackets. Okay, then we also looked at a property, plant and equipment reconciliation note. We said, what is this? We said, we are going to have an amount in our statement of financial position for property, plant and equipment. Only one amount, 40 million. The previous year, we had 46 million. We want to know, how did we move from 46 to 40? For that, we're going to go and look at the note. Can you see it tells us note number 7? So we're going to go down to note number 7, that takes us to our property, plant, and equipment reconciliation note. Right. What was our carrying amount at the end of the year? 46 million, or basically the beginning of the year, 46 million. Right. What were the movements during the year? These were the movements. We had additions, we had disposals, we had a revaluation, we had depreciation. And then we had our closing balance of 40 million. So a user of the financial statement can see how this amount changed from 46 to 40. And remember, for each class of property, plant, equipment, you're going to have a column here in your note. So we're not going to do what we used to do before in our statement of financial position or balance sheet, where we are going to show on the face under assets, where we show vehicles, machinery, equipment. That was baby bookkeeping. Right? We just have one line item known as property, plant, equipment. If you want more information, go to the note. Then we looked at an example, a basic example of where we looked at something to do 5 in your textbook, where we had a piece of land, right? For 2003, the fair value went down from 1.5 to 1.2. So we had to reverse a bit of a revaluation. And we had a revaluation loss. So we said, let's put that for 2003, the information into the note. And so we had this land for part B. We had the cost of 1 million at the beginning of the year. Then we had an increase of 500,000 in 2003 at the beginning of the year. So that increase would be here as revaluation gain. And at the end of the year, there was a decrease down to 1.2. So that's a revaluation loss. So these were our two movements for the year. Now, when you record this gain, you debit the actual land. So that's why, can you see the cost has changed from 1 to 1.5? Right. And the 300,000 is your revaluation loss. Here we won't include that. Or the way the textbook teaches it is that you include that under your accumulated impairments. So your 1.5 less your 3 will give you your carrying value of 1.2. Right, so that was a basic example of how to go to the note. We then looked at the in the same example, something to do 7. We needed to prepare the property, plant, and equipment. But now we're dealing with the machine. Now the machine was using the cost model. We did a whole lot of calculations. So we bought it in 2001 at the beginning of the year for $1 million. We debited our property, plant, and equipment with $1 million, but we only started using it in February. Right. So the depreciation was, yes, it was over 5 years, but the first year, 2001, was only for 11 months. So that's how we got our depreciation. The next year, during the year in 2002, we bought an extra part which added to the value of the machine. So we debited property, plant, and equipment. Right? So when you have subsequent expenditure or you have an impairment, you need to reassess your depreciation calculation. So now you will no longer use the 1 million, but now you will find out what is my new carrying amount. Right? So I added the 100,000. Right? How did we get this 878? It's your original 1 million less depreciation of 174 and 47 plus 100,000 subsequent expenditure. Right? How many months are remaining for 2002? It was from the 1st of April to the end of the year, 9 months. How many months are remaining from this date till the end of its useful life? Well, 11 months has gone by and 3 months. Right. So 14 months have gone by so far. In 5 years, there's 60 months. So 60 less 14 gives you the 46. 46 months left. So we take your new depreciation variable divided by your 46 months left. Times by whatever's left for the year, which is your 9 months. We got our depreciation. Right. That was our 716,000 was our opening balance for 2003. During 2003, they told us that we had that the recoverable amount, let's go to something to do 7. Right. In something to do 7, they told us that they give us two amounts. They tell us that basically the value it used was 300,000 and your net selling price was 25,000. So our recoverable amount is the higher of these two amounts. So our recoverable amount is 300,000 on the 1st of May 2003. So we need to go and calculate what is our carrying amount on the 1st of May 2003 and compare it to the recoverable amount. So how do we do that? Well, at the beginning of the year, we started off with 716. How many months until the 1st of May 2003? January, February, March, April. 4 months. So we processed depreciation for 4 months, which is 72,000. So our carrying amount on the 1st of May is 644,240. What's our recoverable amount? We said it's going to be 300,000. Our recoverable amount is lower than the carrying amount. That means we are recording this asset at too high of a value. We need to decrease it via an impairment. So we will debit impairment and credit accumulated impairment. And then we process, can you see? We had an impairment, so now we got a new amount. There's 33 months left from this date and 8 months left during the year from the 1st of May to the end of the year. So that's your depreciation for the rest of 2003. That's what we did in our previous lecture. Now what we're going to do is we're going to take this information and we're going to answer this question here. Prepare property, plant, and equipment reconciliation note for the 31st of December 2003. So basically this machine this opening balance, these movements for 2003 and this closing balance for 2003, we want to see that in our note. Put this in, this is just a calculation. If you give this to your manager, it's not gonna help him. You can't give this to the users of your fund, the shareholders. It's just gonna be calculations. You need to put this, that's your job as an accountant, is to put this into the property plant and equipment note. That's where your marks are in your tests, your exams. Right? Is being able to draw up statements. So let's start off. Firstly, we need a carrying value of 716. Right. How do we get that 716? It's your gross less your accumulated depreciation. How do I get this gross amount? What you do is you look at any times you actually debited the property, plant, and equipment account. So let's look at the history. We debited it with 1 million. Right. When else did we debit it with 1 million? When we purchased more PPE. Was there any other time we debited property, plant, and equipment? No other time. So the gross carrying amount is going to be 1 million plus 100,000. Okay. So this is how they get the 1,100,000. It's the 1 million plus the 100,000. Okay. Up until this date, has there been any accumulated depreciation or impairment? There's been accumulated depreciation. The first one was 174,000. The second one was 47,000. And the third one, remember, up until the beginning of 2003 was 162. So 3 items of depreciation. No impairment as at 1st of the 1st, 2003, the beginning of the year. So these 3 amounts, the 174, 47, and 162, that's your opening accumulated depreciation. Everything that happened on, everything that happened before the 1st of Jan 2003. So you got your 174 plus your 47 plus your 162. And that gives you your total. Let's double check that. That gives you 383,732. Right. So you take your 1.1 million cost minus total accumulated depreciation to date, and you get 716,268. That's your carrying value. Double check that against our calculation. Yes, our carrying value at the beginning of 2003, which is what the question is asking for. They want to know about 2003 is 716. So we've got this amount done. Right. Your next step in your notes is to go and process any movement for the year. So what were our movements? The first movement was depreciation. Second movement was impairment. Third movement was depreciation again. Right. So let's go and process the depreciation. It was 72 plus the 60. Okay, so you got your depreciation of 72 plus your 66. And that's how they get the 138 depreciation movement for the year. So you got 72,028 plus 66,606. That gives you your 138,634 depreciation movement for the year. Okay, the last movement for the year was an impairment of 344,240. Okay, insert that straight under impairments. Can you see these two have a brackets because they are decreasing the carrying value? Right, those were the movements for the year. We have accounted for movements. Now, what about closing balance for 2003? Okay, so for your gross carrying amount, did we touch the PPE account again during the year? We didn't. Right. So your 1.1 can be carried through. Your accumulated depreciation and impairment, you had an opening balance of 383 at the beginning of the year. You had more depreciation for the year, for this year of 138, and you had impairments of 344. And they go into the account accumulated depreciation and impairment. So that's how they get the 866,606. Now that you have your cost and your accumulated depreciation and impairment for the end of the year, you can work out your carrying value of 233,394, and this should tie up to your calculation, right? Which it does. So now looking at this note, I can know that this was my opening balance because I had these two amounts. These were my movements for the year, and this is my closing balance. Any questions about how we moved from the calculations to the note? Okay, good. We've got a direct message here. Guys, please, if you're sending any questions in the chat, please send them to everyone so we can all see the questions so people can know what question I'm answering. Right? Don't send it directly to me. Send it to everyone. Good morning, sir. Could you please upload the recording of Monday's lecture today? Okay, I'll do that. Good morning, sir. Please remember the class rep election today. Okay, so I don't know what I need to remember about that. Are you guys electing a class rep? I don't think I'm allowed to vote on that. Okay, so I want to ask you, since the beginning, where did you get the 100,000 that was added to the cost price in the beginning? Okay, the 100,000 here was subsequent expenditure. So in our example, event number 2, on the 1st of April, Judy spends another 115,000 on a part for the machine, which will be used until the end of its useful life. So she bought an extra part for 115. Take out the VAT, so you times 100 divided by 115. Right. So this was an extra part that she bought, that 100,000. So that's the increase. Okay, what we're going to discuss today is something quite simple. Okay, we are going to discuss disposing an item of PP and how we're going to record that. Now, it's very simple, especially if you've done accounting before. You know, when you sell an asset, you go through a process known as the asset disposal, right? Where you will open up a new account called the asset disposal account. So it's the exact same process when you're selling a piece of PPE. You're gonna open up your asset disposal account. Okay, so how does this work? Let's take this example here. Let's say we had 2 vehicles, each with a cost of 100,000. Right, so 2 exact same vehicles, 100,000. We purchased them on the 1st of Jan 2009. The depreciation is over 4 years, straight line method, nil residual value. Okay, so what does that mean? That means for each vehicle, we're going to divide by 4 years. So for each vehicle, each year, we're going to depreciate it by 25,000 Rand per year. Okay. We then sold a vehicle for 60,000 Rand cash on the 1st of Jan 2011. Okay, so how many years go by? 2 years, right? 2009 goes by, 2010 goes by, and we sold it at the beginning of 2011. So no time goes by. So it's just 2 years. We only sold 1 vehicle. Right. So how are we going to record this? Now you got your property, plant, and equipment vehicles. You've got 2 vehicles at 100,000 Rand each. One of them is sold, it's gone. And obviously it's an asset account, so it's got an opening balance on the debit side. How am I going to remove this? If it's got a debit balance, I've got to credit this account, taking out 1 vehicle worth 100,000. Where do we send this vehicle to? We send it to the asset disposal account. Okay, this is your contra account. So you debit asset disposal with 100,000 and credit PPE cost with 100,000. Okay. Now, what about all the accumulated depreciation that we passed in relation to the vehicle that we sold? Well, we bought it for 100,000, that one vehicle, and we depreciated over 4 years, and up until 2011, that's 2 years. So 100,000 divided by 4 years times by 2. 2 years have gone by. So the total accumulated depreciation that would have been passed up until the beginning of 2011 would have been 50,000. That is sitting in our accumulated depreciation account. Right. It says 100,000 because it's accumulated depreciation for 2 vehicles. So we are selling a vehicle. So we don't need this accumulated depreciation for this one vehicle to be sitting in here anymore. We need to remove it. Okay, so remember your accumulated depreciation is like sort of a negative asset account. So it's going to have a credit balance. We need to take out 50,000. So we will debit this account with 50,000. And we'll send it to your asset disposal account. So debit accumulated depreciation with 50,000 and credit asset disposal with 50,000. All right. So now that we have these two amounts in front of us, your property, plant, and equipment, and your accumulated depreciation, what's the value of our vehicle? We can immediately see that it's if you got a cost of 100,000 and accumulated depreciation of 50,000, our carrying amount is 50,000. That's the value of our vehicle, according to our accounting records. Right. We then sold it for 60,000 Rand cash. Okay. So that is the amount we sold it for. That's also known as your proceeds. You sold it for 60,000. If you sell something for 60,000 and they give you money into your bank account, you're obviously going to debit bank. Bank is an asset, goes up on the debit side. So what would you do to your asset disposal? You'll credit it with 60,000. Okay. So you've got three figures that you are comparing. The first one is your cost and accumulated depreciation. That's telling you that the carrying amount of my asset was 50,000. That was what I was recording and saying it's worth. But I sold it for 60,000. So can you see, you immediately can understand that we have made a profit on selling this asset because it was worth 50,000, but we sold it for 60. So, but the more mechanical method of working out this profit is you need to balance this account. Right. Which is the greater side? Is it the 100 or the 50 plus the 60? It's the 50 plus the 60 because it gives me 110,000. I transpose it, balancing of accounts. Right. What's my balancing figure? It's 10,000. Okay. If I sold it for 60 and it was worth 50, I made a profit. So profit on sale. Right. This profit on sale is an income. It goes in your statement of comprehensive income under income. And there's right. The first way is to say my carrying amount was lower than what I received for the vehicle. So I made a profit. The second way is this method where you do the balancing figure. But if you get a balancing figure, if the balancing figure is on your debit side of the asset disposal account, it's a profit. If your balancing figure is on the credit side, it's a loss. Right? But that's like the way to remember it off by heart, which is not a nice way. Right? The best way actually is to say, I am debiting asset disposal with 10,000. That means I'm crediting another account with 10,000. If I'm crediting an account, what does it mean? Is it an expense or an income? Income goes up on the credit side. Therefore, it's a profit. Debiting asset disposal 10. Which account am I'm crediting an account. So that means the account is profit on sale. But let's say, for example, we sold it for 40,000. We're changing up the variables a bit here. Okay, so we're not changing the variable that the cost, it was still worth 50,000. Why 100,000 cost? That's accumulated depreciation, 50,000. Let's say we sold it for 40,000 Rand. So we will debit bank because 40,000 comes into our bank account and credit the asset disposal account with 40,000. Okay, which is the greater side? The 100 or the 50 plus the 40? It's obviously the 100. I take that to the side. Okay, which is the greater side? It's the 100,000. You take it, your balancing figure is your 10,000. Okay. If you're crediting asset disposal with 10,000, it means you are debiting another account. If you're debiting, is it an expense or an income? It's obviously expense. So this will be loss on sale. That's one method of determining whether the profit and loss. The other one is just to ask yourself, I got a 50,000, I got 100,000 less 50,000. Carrying amount is 50,000. But I only managed to get 40 for it. So it's going to be a loss. The other method is the memory method, where you say, okay, if my balancing figure is on the credit side, it means it's a loss. If my balancing figure was on the debit side, it's a profit. There's 3 ways to do this, whichever way is easy for you. Okay, sir, can you please repeat how you calculated the accumulated depreciation? Right. So we had a vehicle worth 100,000. We purchased 1st of Jan 2009. So 2009 goes by, 2010 goes by, and on the 1st of the 1st 2011 we sell the vehicle. So 2 years go by. And the depreciation is over 4 years. So 100,000 divided by 4 is 25,000. Right. For 2 years, that gives you 50,000. So that was my accumulated depreciation for the one vehicle. Okay, let's try and put this information into the note. Okay. Now, in these T accounts, there were a few extra things that happened, right? So, for example, if you look here, during the year they bought, at the end of the year they bought another vehicle for 150,000. Then there was also an impairment. Right? I'm not going to go through those transactions. We've already discussed buying more PPE and impairing PPE. So that's not what's important here. I don't want you to worry about how we got this impairment or how we got this purchase. We're just telling you that that's what happened. What's important here is that I want you to be able to look at the slide for the next 2 to 3 minutes. Right. And I want you to be able to know exactly how we got our amounts here into the note. So how we went from our calculations, our T accounts, to the note. Right, 2 minutes. And if you've got any questions, put that in the chat. Okay, we got a question here. If the vehicle is sold during the year, can you just add the depreciation for the year to the accumulated depreciation and then credit the asset disposal account, or do you have to show it separately? Okay, so what the student is asking is, in our example, we sold the vehicle at the beginning of the year. So we didn't have to pass any more depreciation for uh, 2011. Right. But what if we had sold it during the year? So we have to go and calculate more depreciation. For example, let's say if we sold it in June. So for 6 months, we had to depreciate, right? So in that case, what would we do? You would debit your depreciation and your accumulated depreciation and for half the year, and then transfer it to the asset disposal account. So what you've suggested here is the first part. Can you just add the depreciation? Yes, you will add the depreciation to your accumulated depreciation account. So you'll add an extra bit of depreciation here and then transfer the full amount to your asset disposal account. Okay, I don't understand how you got the 150 of additions. As I said before, we are just telling you that it's not an example where we are going over this event and we are going to discuss that we purchased a new vehicle. Right, we purchased a new vehicle. We're just telling you that that's what happened. Right. We're not going over that example. I said it's not important how we got this 150. I just want you to be able to understand that an addition goes to your note like this. If you know that an addition goes to your note like this, that's all you need to know from this slide. But we're not going over an example. You don't have to know where this transaction is coming. We're just telling you that it happened. I don't know how we arrived at 80,000 in the accumulated depreciation and impairment in the end. That how we came to that amount is we balanced this account. This was the greater side, 130. We took it to this side. Oh, no, this was the greater side, 130. We took it to this side. Right? And then we had what you call closing balance. Right? That's your accumulated depreciation. As I say, I don't want you to worry about the transactions here. I want you to see whether you can take it to the note. Actually, this was the balance carried now. So this was your opening balance for, this was your opening balance for accumulated depreciation. You had some depreciation, you had an impairment. So you had a total of 130. You took the 130 to this side and you subtracted the 50, you got a closing balance of 80,000 carried down and 80,000 brought down. So your accumulated depreciation and impairment must go here. So I don't want you to worry about how we got an impairment. There was an impairment. We're telling you that there was an impairment. We've done an impairment example before, right? Where we compared obviously in this question, the recoverable amount was below the carrying amount by 5,000. So we processed an impairment. I don't want you to worry about how we got the impairment now here in this example. I want you to understand that the impairment goes here. Right, your impairment of 5,000, you debit impairment, credit accumulated. I want you to know that it goes here. So how did you get from here to here? Right. So I think time is up. Okay, that's fine. We are almost done now. So what would be the difference in the PPE note if revaluation model was used instead of the cost model? We did an example, right? So in this example where we had land and we had a revaluation, it's basically it'll basically have a movement in revaluation gain or revaluation if there's a revaluation during the year. Right. So in the same note, you can have like this land is at, for example, can be at the revaluation model, and this machine can be at the fair value model. It's a good question. I calculate using movements and accumulate depreciation in the beginning. Maybe that's well. Okay, I see. All right. Okay, the last thing. When we were calculating depreciation, we never ever changed our assumptions. Like for example, what if we decide that the residual value that we've been using is wrong? We need to change it. What happens if we decide that the useful life, for example, is not 4 years anymore, but it's actually 12 years? But, or what if we decide that the method is not appropriate anymore? We're now moving from the straight line to diminishing balance. You can do that. That'll be known as a change in estimates. That we won't learn about this year, right? We will learn about that next year. It's known as IAS 8, but I want you to be aware of that. It's called a change in accounting estimate. That's IAS 8. You will learn about that next year in accounts 2. What if you buy a property? So for example, if you buy a property, a building, and you use it for your business, for the administration of your business, right? That's held for you. So you are using it to carry out your business work. That we know is property, plant, and equipment. But what if you just have some extra cash and you say, I want to buy a building as a store of value and as an investment? Right now, so we're not using it. You're not doing admin in it. You're just keeping it. Right. That won't be property, plant, and equipment IAS 16. You will use a different standard. And that standard is known as IAS 40, right? Your investment property standard. Again, not going to learn about that this year. We're going to learn about that next year in accounts 2 if you make it. Right? You have to pass accounts 1 or 2, otherwise you have to do it again. Now, we have come to the end of PPE. There are some excellent examples here. You need to go and do these examples. Right. Don't forget this week, you are not going to do tutorial 2. Because Mr. Deodat had to take some emergency leave, we skipped over week 2 presentation. He is going to lecture that. He's going to cover that later on. We skipped to week 3. So you're going to have your tutorial 3 on Friday. It's going to be tutorial 3. There was an announcement sent out. Next week is going to be tutorial 3. And so we're going to skip tutorial 4. We're going to skip tutorial 2. We'll do that at a later stage. You're going to go straight to tutorial 3 this week. What is tutorial 3? It's property, plant, and equipment. You've got it here. There's your material. Right. The questions are not from your question book, the thin book. It's from your textbook, the fat book, the maroon color book. Right. It's 3 questions. Go and make sure you do those. And the solutions are here. Right. So go over all these examples. If you don't understand anything, bring it up with your tutors, bring it up with your academic development officers, and as a last resort, you can bring it up with your lecturers. Right. So make sure you know that tutorial 3 will be covered this week. Don't go and do tutorial 2 and go and trouble your tutor with tutorial 2. Right, tutorial 3. Don't forget concept 3, test 3 is open at the moment. You need to go and do that. And the last announcement I want to tell you is that next week, Mr. Deodat is still on leave, so he's not going to come back. So we will be going on to intangible assets next week. Right. Intangible assets is not in your textbook, but you've got notes here. Right. So you can go over these notes, and we're going to cover that next week, intangible assets. IAS 38. Right, that's it for today, guys. Don't forget your TUTs. Don't forget to do your concept test, and next week, intangible assets. Okay, questions. For something to do 7, is there another way of calculating depreciation? There may be. There may be. Will tutorial 1 solutions be posted? There's no need for tutorial 1 solutions to be posted because your solutions are in the textbook. In your question book. The solutions are in the question book. Why do you need the solutions? If you go to 4.1, your solutions are on page 196. So that means you didn't do your tutorial, right? We caught you. If you had done it, you would have seen that your solutions are at the back of the textbook. What's your name here? Akhil Singh. I think you didn't do your TUT, because if you did your TUT, you'd have known where the solutions are. You don't have that textbook. You have to have this textbook. You have to have this question book. That's how you're going to do your question. Then you won't have the solutions. You don't have the questions or solutions. How are you going to do your questions? You need this book. All right. Thank you very much, everybody. I will see you next week on Monday for intangible assets.